In this video, we will learn and watch hammer candlestick in topics. Here are the headings are following here in steps by steps. What is a hammer candlestick? Why are hammer candlesticks important? Understanding hammer candlesticks. How to trade the hammer candlestick. Tips for trading with the hammer candlestick. How reliable is the hammer candlestick pattern? What's the difference between a green hammer and a red hammer candlestick? The bottom line. Limitation of using hammer candlesticks. Anatomy of a hammer candlestick. Trading strategies using the hammer candlestick. Hammer as an observation tool. Hammer near major support zones. Common mistakes and how to avoid them. Common misinterpretations of hammer candlesticks. Backtesting and evaluating hammer pattern performance. Why hammer candlesticks matter in market analysis. Hammer candlesticks and risk awareness. Hammer candlestick in different market contexts. When hammer candlesticks are most useful. If you're a swing trader looking for a long entry at the end of a downturn, a hammer offers valuable information, signaling a short-term shift from bearish to bullish momentum that may itself mark a turning point. The hammer is a single bullish candlestick with a small real body near the top, a long lower shadow at least twice the body's length, and minimal or no upper shadow. It is most effective after a significant downturn or counter-trend pullback and when confirmed with another bullish candlestick, technical indicators, or established support levels. What is a hammer candlestick? Considered a reversal formation and forms when price moves well below open, but then rallies to close near open if not higher. Inverted hammer is the mirror opposite. Forms a candlestick with a long lower shadow, tail, and a small body with little or no wick, looks like a hammer or mallet. Inverted hammer is the mirror opposite. Depending on the previous trend, a hammer may be referred to as a hanging man or shooting star, but the same concept applies. Bullish or bearish bias depends on previous price swing or trend. A hammer after an uptrend is called a hanging man. An inverted hammer after an uptrend is called a shooting star. Why are hammer candlesticks important? May act as a leading indicator suggesting a shift in bullish-bearish momentum. Completed hammers may help to either confirm or negate a potential significant high or low as occurred. Price drives higher or lower, hammering out a top or bottom before closing back towards open. Significance increases with length of shadow, ideally 2 to 3 times the size of the body, as well as time frame. Hammers may also help confirm or strengthen other reversal indicators, i.e., may occur as part of tweezer formation, next to doji, etc. A hammer fails when new high is achieved immediately after completion, candle, and a hammer bottom fails if next candle achieves new low. A hammer fails when new high is achieved immediately after completion, candle, and a hammer bottom fails if next candle achieves new low. Understanding hammer candlesticks. The hammer is one of the easiest, most intuitive candlesticks to recognize because, well, it looks something like a hammer. It has 3 components: a small real body located near the top, a long lower wick that is at least twice the body's length, and a tiny upper shadow or no upper shadow. The unique shape tells traders that even though prices initially dropped, buyers stepped in to reverse the decline, pushing the closing price up to near the opening price. This signals a potential shift from bearish to bullish sentiment/momentum. A hammer with a closing price higher than the opening price is an even stronger bullish signal, giving traders even more confidence. It's still a bullish signal if the closing price remains below the open, but the failure to push the close higher is a sign of residual selling pressure, prompting most traders to proceed with more caution and seek additional confirmation. Hammers are most reliable after a significant downtrend, especially if they occur at an area of established support, whether via previous price action or major moving averages. How to trade the hammer candlestick. There are several basic steps to effectively trading the hammer. Step 1. Pattern identification. Identify the hammer. Some charting software offers candlestick analysis, including the hammer. If the trader is eyeballing, they would need to confirm the small body near the candle's high, the long lower shadow, and a minimal or non-existent upper shadow. Step 2. Confirm the pattern. Good traders wait for confirmation, most often in the form of a bullish candle that shortly follows the hammer and closes above the hammer's high. Additionally, increased volume on the confirmation candlestick enhances reliability. Technical indicators such as the Relative Strength Index, RSI, also offer useful confirmation. Step 3. Trade entry. More aggressive traders may enter at the close of the confirmation candlestick if it closes above the hammer's high. Others may enter at the opening of the day following the confirmation candle. Step 4. Stop-loss entry. The most common approach is to place the stop-loss order just under the hammer's low. If the price falls below the hammer's low, the pattern has definitely failed. Step 5. Profit targeting. Traders usually set profit targets using nearby resistance levels, moving averages, Fibonacci retracements, or pivot points. But before entering the trade, most traders would want to be sure the market has enough room to run to achieve their minimum risk-reward ratio before hitting resistance levels or other areas where profit-taking makes sense. Tips for trading with the hammer candlestick. Traders keep these points in mind when using the hammer candlestick. Look for longer shadows. Longer shadows signal stronger buyer strength, as buyers aggressively reversed prices from intra-period lows. The lower shadows should be at least twice the length of the real body, but on the most bullish hammers, they can be 3 to 5 times longer. Confide in confluence. A hammer appearing near major support levels, trend lines, or Fibonacci retracement zones dramatically enhances reliability. Such confluence indicates multiple traders recognize the level as a buying zone, strengthening the reversal signal. Technical analysis combos. For confirmation, use indicators such as the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, or moving averages. Volume analysis. Increased trading volume accompanying the hammer or confirmation candle indicates strong institutional buying support, validating the reversal. Trading strategies using the hammer candlestick. The hammer candlestick can be used in multiple effective ways, especially during a downtrend. Breakout entry strategy. Enter a long position after the hammer forms. Confirm entry when price breaks above the hammer's upper wick. Stronger signal if supported by higher trading volume fundamentals. Trend reversal signal. Most powerful when appearing in a downtrend. Indicates buyers may be regaining control. Short-term trading use. Provides precise entry points when combined with technical indicators. Confirmation tool strategy. Pair with RSI for oversold confirmation. Look for volume spikes to validate momentum shift. Combine with patterns like engulfing candles to reduce false signals. Using confirmation techniques alongside the hammer pattern increases reliability and strengthens overall trade confidence. Hammer as an observation tool. Beyond immediate trade setups, the hammer candlestick is a valuable observation tool for spotting potential market turning points early. Early reversal detection helps identify possible trend shifts before they become widely recognized, allows traders to prepare positions in advance. Improved risk management supports better stop placement and position sizing, encourages strategic rather than reactive decisions. Adaptability to market conditions, can appear in various environments, trending or ranging markets. Context determines the strength of the signal. Use in volatile markets, particularly effective near key support levels. Signals potential reversal when price repeatedly tests critical zones. Better entry and exit timing. provides early awareness of momentum shifts, helps reduce the negative impact of market volatility. Consistent monitoring of hammer patterns enhances market awareness and supports more disciplined, strategically timed trades. Hammer near major support zones. One of the strongest uses of the hammer candlestick is when it forms near major support levels, areas where buyers have historically stepped in to prevent further price declines. Support confirmation. When price reaches a known support zone and forms a hammer, it suggests buyers are defending that level, indicates potential reversal from a key price area. Volume confluence. Increasing volume alongside the hammer strengthens the signal, shows active buyer participation at a critical level. Stronger setup. The combination of support plus hammer improves trade probability, helps filter some weak or false signals. Common mistakes and how to avoid them. Even experienced traders can make mistakes when trading hammer candlesticks. Understanding these common pitfalls and knowing how to avoid them can significantly improve trading performance. In uptrends, hammer candlesticks can sometimes appear during consolidation phases. While a green hammer in an uptrend might suggest a potential pullback, traders should be cautious as the pattern may not always signal a reversal. Instead, traders might interpret it as a temporary pause in the uptrend and wait for further confirmation before adjusting their positions. When hammer candlesticks are most useful. Hammer candlesticks are most useful in specific market conditions where their signals are clear and reliable. Traders should focus on using these patterns in the following scenarios. 1. After a clear downtrend. Hammer candlesticks are most reliable when they appear after a series of lower highs and lower lows, signaling a potential reversal. The longer the downtrend, the stronger the reversal signal tends to be. 2. Near key support or resistance levels. Hammer candlesticks near critical price levels are more reliable because they confirm that buyers or sellers are actively defending those levels. Traders can use these levels as entry points or confirmation points for their trades. 3. With increasing volume. Hammer candlesticks that form with higher volume are more reliable because they indicate stronger market participation. Volume helps confirm that the reversal or breakout is genuine rather than a temporary fluctuation. 4. On shorter time frames. Hammer candlesticks are often more reliable on shorter time frames, such as daily or hourly charts, where the reversal signals are clearer and less influenced by longer-term trends. 5. In combination with other indicators. The most reliable hammer trades occur when the pattern is confirmed by other technical indicators, such as moving averages, trend lines, or volume spikes. Combining hammer candlesticks with these tools increases the signal's accuracy. Traders who understand when hammer candlesticks are most useful can avoid relying on them in less favorable conditions, reducing the risk of false signals and improving their overall trading performance.
How reliable is the hammer candlestick pattern? The hammer candlestick pattern is moderately reliable as a single indicator, but reliability improves when investors also consider trading volume, RSI, MACD, and moving averages. The hammer candlestick pattern alone may lead to false signals, especially in low-volume markets. What's the difference between a green hammer and a red hammer candlestick? A green hammer indicates that the price closed above its open and signifies a strong bullish reversal. A red hammer suggests that selling pressure pushed the closing price below the open, but buying pressure pulled it back up. The bottom line: the hammer candlestick helps swing traders enter long positions after downtrends while minimizing the risk of catching a falling knife. That's because the hammer pattern reveals a potential shift in buying pressure and the balance of power between bears and bulls. Traders look for confirmation from subsequent bullish candles and higher volume, ideally supported by other technical analysis indicators like the RSI or MACD, pivot points, or Fibonacci levels. By combining the hammer pattern with disciplined trading, traders can effectively manage risk, avoid common pitfalls, and improve their results when looking to enter bullish reversals. The hammer candlestick pattern is a valuable tool in a trader's arsenal, offering a potential glimpse into a market's turning point. While it primarily signals a bullish reversal at the end of a downtrend, understanding its limitations is crucial. Remember, the hammer is just a single candle, and confirmation from other indicators and price actions strengthens its message. Don't forget its inverted counterpart, the bearish hammer candlestick, which suggests a potential reversal from an uptrend. Before deploying the hammer pattern in live trading, consider practicing mastering the hammer and its limitations. You can gain valuable insights to inform your trading decisions with greater confidence. Anatomy of a hammer candlestick. Understanding the anatomy of a hammer candlestick is key to interpreting it correctly. It has three main parts: a small body, a long lower wick, and little to no upper wick. The body reflects the open and close prices, while the wicks show the session's high and low. For a valid hammer, the body should be relatively small. The lower wick should be much longer than the upper wick. The close should be near the top of the body, signaling buying pressure. The long lower wick shows that buyers rejected lower prices after early selling. Hammers can appear across all markets, forex, stocks, or crypto, but their significance depends on the broader market context. Mastering how to trade the hammer candlestick requires more than just recognizing the pattern. It demands understanding when and how to apply it in real trading scenarios. While the hammer candlestick itself is a powerful signal, successful trading around this pattern involves combining it with other technical elements. Traders who focus solely on the pattern without considering broader market conditions often miss opportunities or enter trades at less favorable times.